In a market that is supposed to move on clean logic, one set of numbers is behaving like a siren. 863 tons. That is the reported amount of net gold bought by central banks in a single year, not spread across a quiet decade. 1 year. And in the final quarter alone, the pace did not fade. It climbed to roughly 230 tons. When the biggest balance sheets on Earth accelerate into year-end, that is not a retail frenzy. That is a structural shift. Then the timeline compresses. Not months, not weeks. In 48 hours, you can watch the public narrative whipsaw from gold is dead money to gold is the only thing moving. And the strangest part is how many people still assume this is random. They assume it is just traders pushing buttons. But the data shows something else entirely. While headlines argue about whether the price has gone too far, institutions have been accumulating with methodical patience. They already know what most people are only beginning to notice, and what I am about to lay out changes the way the entire move makes sense. Because the quiet accumulation phase is ending. Not because someone declared it, because the numbers, the flows, and the contradictions are forcing it into the open. Welcome to Vault Signal, where we decode what matters before it becomes a headline. If you like calm evidence-first analysis, consider subscribing the way you would keep listening to that wise elder who always seems to understand the room before the room understands itself. And drop a comment telling me where you are watching from. Because gold behaves differently depending on whether you are looking from a capital city, a manufacturing hub, or a household trying to protect purchasing power. Now let us get forensic. The story is not that gold went up or down. The story is that a multi-year campaign of accumulation is becoming impossible to hide, and the market is starting to price that reality in real time. Start with the hard anchor, reported official sector demand. In 2025, central banks collectively added around 863 tons of gold on a net basis. Put that in perspective. A ton is 1,000 kilograms. A standard large gold bar is roughly 12.4 kilograms. So we're not talking about a symbolic stack. We are talking about tens of thousands of bars being absorbed into vault systems that are built for sovereign reserves. That is not a trade you flip next week. That is a long horizon decision. Then there's the fourth quarter detail that most people miss. Roughly 230 tons in Q4, about 6% higher than the prior quarter. If demand was fading, you would expect deceleration. Instead, you see persistence, then an uptick. That is what conviction looks like when the buyers do not need applause. And the buying is not anonymous. The National Bank of Poland was reported as the largest disclosed buyer in 2025, adding about 102 tons. One institution, 1 year, triple-digit tonnage. Think about what has to happen inside a central bank for that to occur. Committees align, procurement channels activate, custody plans adjust, reporting frameworks update. This is operational. It is slow. It is deliberate. And because it is deliberate, it carries information. At the same time, China is showing a different kind of signal, a blend of public participation and physical pull. By the end of 2025, Chinese gold ETFs were reported to have exploded in size, with assets under management up about 243% to roughly RMB 242 billion. Around US 35 billion, and holdings more than doubling to about 248 tons. ETFs are not jewelry, and they are not central bank vaults. They are the bridge, the mechanism that lets broad pools of capital express demand without touching a bar in their hands. Then January 2026 arrives, and the quiet phase gets louder. Withdrawals from the Shanghai Gold Exchange were reported at 126 tons for that single month. 2 billion, associated with about 38 tons of added holdings in January alone. 6%. If those numbers feel abstract, make them concrete. That is official buying staying steady, financial buying accelerating, and physical movement pulling metal out of circulation, all within the same window. That is not a market cooling off. That is a market transitioning. So why does it feel confusing when you open a chart? Because the market is sending two signals that seem to contradict each other. One signal is the headline price, whipping around big psychological levels, surging, pulling back, and making it easy to label the move as speculation. When price is volatile, commentary becomes louder. People argue about bubbles. People argue about manipulation. People argue about timing. That debate spreads because it is emotional, and emotion is shareable. The other signal is the slower, quieter data that does not fit into a single candle. Central bank purchases remain elevated. A named central bank like Poland adds 102 tons in a year. China shows ETF assets up 243% to RMB 242 billion. Holdings more than double to 248 tons. January shows 126 tons of Shanghai withdrawals and RMB 44 billion of ETF inflows. These are not opinions. These are structural moves that remove supply, add persistent demand, and reshape the balance. When those two signals diverge, that is the start of a dislocation. And dislocation is the signature of the quiet phase ending. To understand why, you have to zoom out and look at how these cycles have ended before, not because history repeats perfectly, but because the mechanics rhyme. In 1979, gold did not become important because someone discovered it was shiny. It became important because confidence in the old monetary rules began to fracture. Inflation expectations surged. Energy shocks hit. Policy credibility wobbled. The result was a repricing so violent that gold became a nightly news obsession. The quiet phase ended when volatility forced everyone to pay attention. Then, the 1980 period showed the other side of that coin. Policy response tightened. The market digested. Volatility remained, but the extreme urgency faded over time. That pattern matters because it shows how a repricing can be fast, while the consequences can take years to absorb. Now jump to 2007. The early gold move into that era was not a social media stampede. It was a slow institutional awareness that the credit machine was carrying hidden risk. In 2008, forced selling hit many assets, and gold did not move in a straight line, but its role expanded. Then from 2009 into 2011, as central bank balance sheets expanded and policy regimes shifted, gold pushed into broad public attention again. The pattern was consistent. First, discrete accumulation, then visible stress, then repricing that made the old explanations look incomplete. And here we are again, in a different context, but with familiar mechanics. Persistent official sector demand. Expanding financial demand, physical flow signals that suggest real metal is being pulled, and price behavior that is starting to act like the market is struggling to stay quiet. Now let us talk about the players, because the ending of a quiet accumulation phase is not caused by one villain or one hero. It is caused by a network of incentives colliding. Central banks are the most obvious. They manage reserves, defend currency stability, and think in decades. When they buy gold, they are not seeking a quick profit. They are seeking resilience. The precise motivation differs by country. Some want diversification away from a dominant reserve currency. Some want insurance against sanctions risk. Some want a hedge against systemic volatility. But the mechanical result is the same. Metal leaves the floating supply pool and enters long-term storage. Then you have domestic market ecosystems. And China is the clearest case study because it has multiple channels that can amplify each other. 2-ton increase to roughly 2,308 tons. The financial channel shows ETFs scaling rapidly, reaching RMB 242 billion in assets, and about 248 tons in holdings, then adding about 38 tons in 1 January. The physical channel shows exchange withdrawals, like there are reported 126 tons in January. These channels can move in parallel, and when they do, they create pressure that the global market cannot ignore. On the other side, you have the global paper market, futures exchanges, bullion banks, market makers, funds. Their role is to provide liquidity, hedge exposure, and translate demand into tradable instruments. Most of the time, that system is efficient. But paper systems are built on netting and rolling positions. Physical systems are built on delivery, custody, transport, and vault capacity. When both systems are aligned, price discovery looks smooth. When they diverge, stress shows up as spreads, premiums, and sudden moves that feel out of proportion to the headline. This is the part no one is discussing with enough seriousness. The paper market can reflect sentiment instantly. The physical market reflects logistics. Sentiment can turn in seconds. Logistics cannot. When logistics are tightening while sentiment is volatile, it often means the market is in the process of transferring metal from weak hands to strong hands. So what exactly is the dislocation here? It is the gap between what the market says and what the market does. The market says, through commentary, that gold is a trade. The market does, through flows, that gold is being treated like a reserve asset again. The market says, through price volatility, that gold is unstable. The market does, through official accumulation and ETF expansion, that gold is being accumulated precisely because stability is questioned elsewhere. That contradiction cannot persist forever because eventually price has to clear the true balance of supply and demand. And when the clearing price is higher than where the market has been comfortable, the transition feels like a shock. Now let us put the evidence in sequence because sequence matters. First, official demand stays elevated for multiple years, including that reported 863 tons in 2025. Second, the pace accelerates into year-end with about 230 tons in Q4. Third, named institutions confirm participation, like Poland with about 102 tons. Fourth, public financial channels expand, like China ETFs, with assets up 243% to RMB 240 billion in holdings up to about 248 tons by year-end. Fifth, short-term bursts confirm persistence. like January 2026 with 126 tons of Shanghai withdrawals, RMB 44 billion of ETF inflows, and roughly 38 tons added to ETF holdings in a single month. Those are separate data points, but together they form a single narrative. Demand is not only present, it is broadening across buyer types. And when demand broadens, the quiet phase ends because the market runs out of ways to keep it quiet. So how does the ending actually happen mechanically? It happens through a chain of pressure points that suddenly connect. Think of a theater with a small door. For a while, the crowd can enter calmly. That is accumulation. But if more and more people arrive, the door does not get wider. The same door now creates a bottleneck. That bottleneck is volatility. It is not proof of irrationality. It is proof that the system's capacity to absorb demand at current prices is limited. In markets, that door is liquidity at the margin. It is the amount of metal available to be sold without changing price too much. When central banks and long-term holders absorb metal, they reduce that marginal liquidity. When ETFs add holdings, they further reduce it. When physical withdrawals pull metal out of exchange systems, they reduce it again. Then, when volatility rises, risk managers step in, leverage is reduced. Some positions are forced to close. That can create sudden dips that look like weakness on the chart. But if the underlying demand is real, those dips get met by steady buying, and the market stabilizes at a higher level than it did before. This is why the quiet phase ending often looks messy. It is not a clean staircase. It is a tug of war between financial positioning and physical pull. And it is also why expert opinions start contradicting each other at this stage. One expert looks at charts and sees overextension. Another looks at flows and sees structural demand. One expert looks at rate models and says gold should not behave this way. Another looks at reserve behavior and says models are missing the regime shift. Those contradictions are not noise. They are a symptom of transition, because transitions break old frameworks. Now, forward analysis without prophecy. Historically, when official sector buying remains elevated and private financial demand expands at the same time, gold tends to experience a repricing cycle. The path can vary, but the pressure is consistent because supply is slow to expand. Mines cannot double output in a year. Refining cannot instantly scale without limits. An above-ground stock is not all for sale at any price, because much of it sits in long-term hands. So there are three broad scenarios that fit this pattern. A conservative scenario is a choppy consolidation, where headline price swings remain large, but progress is slow as the market builds a new range that matches the new demand profile. In that scenario, the quiet phase is still ending, but it ends through repeated tests rather than one dramatic break. A moderate scenario is a stair-step repricing, sharp legs higher followed by consolidations, each driven by renewed confirmation and flows. Central banks continue to add, ETFs continue to accumulate after dips. Physical indicators remain firm. Each time the market tries to dismiss the move as a fad, the data pulls it back. An aggressive scenario is time compression. A financial stress event, a sudden policy shift, or a confidence shock forces demand into urgency. Then the market reprices quickly because the marginal supply is too thin. This is where psychological levels become unstable, where volatility becomes the headline, and where the quiet phase is not just ending, it is gone. What is worth watching if the goal is understanding, not prediction? Watch whether official buying stays persistent. Watch whether ETF holdings keep rising after volatility spikes, because that indicates demand is not purely momentum. Watch physical flow signals like exchange withdrawals and regional premiums. And watch how gold behaves during broader market stress. Does it get sold aggressively and stay weak, or does it get sold briefly and then recover, suggesting the dips are transfers rather than exits? There is another layer that makes this moment unusual. The modern gold market is not one market. It is a stack of markets. There's the futures market, where contracts are traded in huge volume and most positions are never delivered. There's the OTC market, where large blocks change hands quietly between institutions. There's the ETF market, where shares represent claims on pooled bullion held by custodians. And there is the physical market, where bars must be refined, shipped, assayed, and vaulted. When people talk about gold as if it is one simple object, they miss how these layers interact. This is why the late stage of accumulation often feels like two worlds at once. The screen price can look calm for a while, even as the physical system grows tighter. The screen price can also look chaotic for a while, even as the physical system is being steadily drained. Those can both be true because the top layer can absorb and release pressure with paper claims, while the bottom layer has to deal with metal. Look at the China-related indicators again with that lens. An ETF inflow is a financial event, but it has physical consequences when the fund sources metal. A Shanghai Gold Exchange withdrawal is a physical event, and it often reflects downstream demand. That is not easily reversed. If those signals are strong at the same time, it suggests demand is pressing across multiple layers, not just one. And that is where the dislocation becomes measurable, even if you do not have access to every private premium. You see it in timing. You see it in the way dips get bought faster than models expect. You see it in the way narratives fail to kill the move. You see it in how often new participants appear after volatility, not before it. A market driven by structural demand often becomes more volatile and then continues because the buying pressure does not disappear when the chart looks scary. This is also where institutional behavior becomes revealing. In calm periods, intermediaries compete by tightening spreads and offering leverage. In stressed periods, those same intermediaries protect themselves by widening spreads, raising margin, shortening credit, and reducing risk. That process can create sudden price drops that look like a reversal. But if the underlying demand is real, those drops become the mechanism of transfer. The risk-controlled sellers are forced out, and the patient buyers step in. So what could compress the timeline here? It does not have to be one dramatic event. It can be a series of smaller pressures that add up. Currency volatility that makes reserve managers uncomfortable, a funding market wobble that shifts collateral preferences, a geopolitical headline that increases demand for neutral assets, or a policy pivot that changes real rates expectations. The details can differ, but the pattern is consistent. When uncertainty rises and trust in paper claims is questioned, the demand for a neutral reserve asset tends to grow. Now consider why the phrase quiet accumulation mattered in the first place. Quiet accumulation is a phase where large buyers can build positions without advertising them. They do it by staggering purchases, using multiple channels, and avoiding the kind of urgency that spikes price. But every accumulation phase creates its own ending. As more metal is absorbed, the market becomes more sensitive. It becomes easier for a modest new wave of demand to move price. It becomes harder to hide. It becomes impossible to pretend the move is just noise. That is why you see public contradictions now. One headline focuses on a pullback and calls the move over. Another headline points to central bank buying and calls it a new era. One commentator says gold is a fear trade. Another says gold is a reserve trade. The truth may include pieces of each, but the important point is that a market does not generate this level of narrative conflict in a truly quiet phase. Conflict is a sign that the old story is losing control. And when the old story loses control, attention follows. Attention brings new flows. New flows stress the system. Stress reveals where the weak points are. That is the cycle. Now, the choice ahead is not about being bold. It is about being awake to structure. There are always two groups when a quiet phase ends. The first group watches flows and recognizes regime shifts early. They understand that 863 tons of central bank buying is not trivia. They understand that 230 tons in Q4 is conviction. They understand that Poland adding 102 tons is policy in motion. They understand that China ETFs growing to RMB 242 billion and 248 tons is demand migrating into financial plumbing. They understand that January's 126 tons of Shanghai withdrawals and RMB 44 billion of ETF inflows are not the footprint of a fading story. The second group watches only the last candle. They wait for certainty. They treat every dip as proof the story is over and every surge as proof it is too late. They move with the crowd because the crowd feels safe. But the crowd is always last. Institutions move first because their mandate forces them to manage risk before it becomes obvious. Households move last because they do not have to decide until the story is on every screen. That is why information gaps become wealth gaps over time. Not because anyone is magically smarter, but because timing and understanding changes timing and behavior. And in a transition like this, timing is everything. This is Vault Signal, where we decode what matters before it becomes headlines. If this connected dots you had not connected before, you know what to do. Because the real question is not whether gold will have volatile days. The data already implies that. The real question is whether the signals are recognized before the quiet accumulation phase fully ends and the repricing phase writes the story in letters too large to ignore.